Good morning, everyone. Thanks for joining the weekly research morning call. Today, we are going through the US and Singapore strategy and stock picks. Yeah, so without further ado, I'll hand over to Zeng for technical pause. Zeng, please.
Thanks, Mel. I'll begin with the technicals. So first up, looking at S&P 500, last week we saw an extension of the bearish momentum, and then we actually feel a price gap around the 4,970 level over there. So I think for this week wise, we could see a slight rebound given the the big sell down we saw last week. To retest the 5,030 to about 5,080 resistance area for now. Yeah, for the lower supports wise, it's likely between 4,845 to 4,945 area. Next slide. Yeah, so for individual counters, first one we have a technical sell for Microsoft at $413.64. Take profit levels at 498 as well as 398 as well as $383. The stop loss at $428. The stop loss closed at $399.12 on Friday. So from Microsoft, looking at chart wise, there was a breakdown of an uptrend channel, and then also concurrently there was also a breakdown of the $418 support level, which the price actually traded in the range for a while in April. So it actually provides a bearish signal. With that, the momentum indicators are also flashing bearish divergence as well as decreasing momentum as well. So you can head towards these two levels in the short term. And then the price has actually retested the first take profit level at $398 on Friday. Next slide. So next one is on Singapore Airlines, also technical sell at $6.72, take profit level at $6 and $5.78, stop loss at 640, and the stop loss goes at 625 on Friday. So looking at SIA's chart, recently it has actually consolidated in this bearish flag for a very long period, about 2 months, between about 630 to about 660. And then recently price actually broke down below the support level, and so we could see that there's decreasing momentum at MACD and RSI as well. So the stock could pull back further towards these two previous support levels. Next slide. The next one is a technical sell for Costco shipping at 14.1 cents. Take profit levels at 13.2 cents and 12.5 cents. A stop loss at 14.9 cents. The stop loss closed at 13.2 cents on Friday. So for Costco shipping, the chart also flashes some bearish signals. Firstly, there was a breakdown of a bearish flag highlighted in blue. This was following a false breakout above the 14.9 cents level. Subsequently, price did a retest of the 14.9 cents and found resistance before breaking down the bearish flag. So this gives us a bearish signal with decreasing momentum of MACD and RSI as well. So the stock could pull back towards these two prior support levels in this current downtrend. And on Friday, the stock actually retested the first take profit level at 13.2 cents already. Next slide. And the last one is a technical sell for iFast at 651. Take profit levels at 610 and 545 with a stop loss at 675. The stop loss goes at 658 on Friday. So looking at iFast, it was also consolidating in the bearish flag between about 660 to about 710. Recently, there was a breakdown below the support as well, with decreasing momentum of the RSI and MACD. So we could see further decline in terms of the share price to retest these two prior resistance as well as a prior range support level as well. Next slide. So this is just a summary of the 4 trades initiated. So on Microsoft, it actually hit the first take profit level. Currently, it's up about 3.5%. For SIA, it's currently down about 0.5%. Costco shipping, it's hit the first take profit level as well, up about 6.4% currently. And for iFast, it's currently down about 1.1%. Next slide. So next one, I'll hand over to Ambrish for the US stock picks. Thanks.
Thank you, Zain, and good morning, everyone. So moving on to some of our US stock picks for the second quarter of 2024. Next slide, please. So first one is the Microsoft. So Microsoft, it basically divides its total revenue into three segments, which is Intelligent Cloud, which includes its Azure Cloud Service. And the Intelligent Cloud is the fastest growing segment and the largest contributor to total revenue. And the one in the line in green is the Productivity and Business Processes segment, which includes the Office 365 revenues from Office 365, whereas the red line is for the more personal computing segment. So we believe that the total revenue for Azure, it should continue to be growing by about a 30% range. And this is mainly because of continued demand from the digital transformation trends where the companies, they shift their workloads from on-premise to the clouds, as well as its integration capabilities with Office 365. And also the companies through Microsoft, they can get access to open AIs, large language models, and with the use of that, they can build their own applications wherein, for as an example, if they want to introduce a chat application for their website, then they can do that through the OpenAI's language models. And we expect, as I said, we expect the robust demand to continue for Azure. Meanwhile, for Office 365, Microsoft, it has a market share of about 90% in the productivity software market. However, despite this, it has been growing in double digits, and this is mainly because of continuous product enhancements and new feature additions to like Excel or Word, and also because of rising need to manage tasks and workflows. Whereas the for the more personal computing segment, it witnessed a drop last year, and this was mainly because of the slowdown in PC shipments, whereas it has rebounded, and we expect the rebound to continue in the second half of 2024, and mainly because we can witness a upgrade cycle, as most of the personal computers, they have been purchased over 4 or 5 years back. So we might witness a upgrade cycle, as well as the AI powered laptops, they are expected to be launched by the end of this year. So we can further see a boost in PC shipment sales, which can basically help Microsoft to generate more revenues from its Windows OEM segment, wherein the PC manufacturers, they install Microsoft's Windows software on their personal computers. So overall for Microsoft, we have an accumulate recommendation with a target price of $450. Next slide, please. Thank you. So moving on to the second stock pick, Salesforce. So for Salesforce, it's witnessing a strong demand for its core products like the Sales Cloud and Service Cloud, which basically helps to companies to provide enhanced customer solutions. And it's also focusing on cross-selling its products to its existing customers instead of providing in-point solutions. It's basically bundling its multiple products into its customer 360 platform, wherein the users, they get the information across the segments, and as a result, the bundling strategies, it's helping Salesforce to generate a higher average selling price. And also, if you look at the chart, the operating margins and the net margins for Salesforce, they have significantly grown from the second half of 2023. And this is mainly because of continued cost-cutting initiatives like job layoffs. So last year, they cut its workforce by about 10%. So and right now we are witnessing the full effects of the cost-cutting initiatives that were initiated, and as a result, we expect continuous margin expansion going forward. And lastly, Salesforce, it has also introduced a price hike across its product base by about 10% or so last year. So we expect that it should hit its customer base at the renewals by the end of this year, and it should provide a boost to its top line growth. And so overall for Salesforce, we have an accumulated recommendation with a target price of $323. So that's all for me. I would now like to pass it on to Jonathan. Thank you.
Thanks, Ambrish, and good morning, everyone. So talking about my two stock picks, the first would be Alphabet. So essentially for Alphabet, they are the main or the dominant player in the digital advertising industry. At the same time, they're also a monopoly in many of its different verticals. So you just think about your Google Maps or even Android, and for the most part, even Chrome or search or Google search. So when we talk about output, it's mainly about a recovery in the advertising industry. And when you look at this chart here, look at the last three bars on the right. There is a sort of a acceleration in revenue growth. Ad revenue, year-on-year revenue growth for the last quarter was about 11%. So not as high as pandemic peaks, but it's actually getting up there. If you look at from the period of most of 2022 to the early parts of 2023, there really wasn't much growth because there was significant weakness in the overall industry. So when we look at Alphabet, it's more of a re-acceleration in their top line. At the same time, their margins are also improving quite significantly. The main reason for this is because they cut a lot of costs. Well, it's twofold. The first is that they cut a significant amount of costs over the last year or so. And the second part is they are leveraging AI quite significantly. And they've been doing this for quite a while, actually, but they're leveraging AI in a lot of their digital advertising products. So it's delivering better performance and better ROI for its advertisers. Essentially, that kind of drives up the prices of a lot of their advertising slots or their CPMs. At the same time, when you talk about an AI leverage product, the closest thing I guess the easiest illustration would be their YouTube Shorts, which they've been monetizing very well. This continues to grow and it continues to be take up a larger portion of eyeballs away from I guess more long form or more static kind of advertisements. So aside from both the margin growth and the revenue growth, when you look at valuations also right now, we're trading about 20 times forward PE, which is in line with its average. So not it's not very undervalued, neither it is overvalued. I think there is still a little bit more run, especially as they continue to leverage AI moving forward. And of course, as the leader in their industry, naturally you have to pay a little bit more premium because any recovery basically flows to either them and to a small extent to Meta. Yeah. So we have an accumulated rating on Alphabet with a target price of $104. Next slide. My next counter will be on Nvidia. I think no surprise to everyone, but the main story for Nvidia it's a significant growth story, very robust AI demand, which begs the question, whether the demand is sustainable in the near term. Obviously, we do think that demand is going to be very sustainable, mainly because we are seeing not just your internet tech companies, but also a lot of hyperscalers and a lot of I guess more sovereign nations trying to figure out and investing more money into AI projects. And given that Nvidia is the main leader in AI GPUs, they have about 85% market share. Most of the investments, from companies or from sovereign nations, when you talk about AI, most of them will flow into Nvidia, especially because they do their components are essentially the highest ASPs. You just talk about one of their GPUs right now, their Hopper is about 25 to 30,000 US dollars. They just launched their newer Blackwell range, which we expect to be about 20% higher. So we do think revenue growth will be sustainable at least in the near term. You're still seeing quite a lot of demand. When you just look at the latest news from a company like Microsoft, they're planning to invest about $100 billion in their new Stargate project. I believe a lot of it will flow into Nvidia as well. So similar to Alphabet, maxing its margins, which right now because they only design their own chips, they don't actually manufacture it. The capex for them is very low, and most of the expenditure is just on R&D. So it's a fairly scalable business. When you look at gross margins right now, hovering about mid 70% range, which is very high, not just for the semicon industry, but for I guess most other industries. I think the only other industry that has higher margin than this is probably digital advertising, close to 80%. So they're very high up there. When you look at their bottom line margins, they're right now about 50% net margins. So every dollar that they earn, they keep about 50%, which is a fairly significant cash injection in terms of profitability, which they can deliver through buybacks and dividends. Yeah, so overall, still a very compelling growth story for Nvidia, at least with respect to a lot of the AI demand. we have and talking about valuations right now, they're trading about 35 times PE at the end of last month. So right now, probably significantly lower given the sharp sell down. So we think, even though it is relatively higher compared to rest of the Nasdaq and the S&P 500, given the high growth rate, we do think that it's fairly undervalued right now, moving forward. Yeah, so we have a buy rating with a target price of $970 US. So that's all for me. I'll hand it over to Helena from Amazon. Thank you.
Oh, sorry. Thank you, John. So I'll be covering on Amazon. So Amazon, for their retail services, it accounts for around 85% of the company's revenue. Their retail operating income improved more than triple year-on-year in the last quarter. This is largely driven by the continued effort to improve efficiency and fulfillment process. So they have their plan of regionalization and adding more delivery hub. So all these is aiming to shorten their delivery time and lower their transportation distance. And they have been quite successful in doing so. Their same-day delivery is increasing by around 65% year-on-year, and their cost to serve is declining by 45 cents per unit. So of course, this is also partially because they're facing lower fuel prices. So with all these improvement in efficiency and reduced costs, we are seeing improvement in the margins. Both gross and operating margin is improving significantly from the low level in the fourth quarter of 2022. Was operating margin expected to reach the pre-pandemic level of 6 to 7%. Moving on to AWS, their AWS revenue growth has dipped in the previous quarters because consumers are moderating their spending. But we're rather bullish as the effects seem to have been bottomed out. The AWS growth start to show signs of stabilizing due to mega trend of adopting generative AI in general. And of course, consumers begin spending again. So we start seeing accelerated new deals and backlog conversion. Their order backlog grew around 40% year-on-year in the last quarter. So we do believe that AWS is in a very good position to attract more consumer spending. They have the largest market share, and also it's easier for them to attract new customers. Also for the existing customers, they already have stored the data on AWS. The switching cost is quite high, so it's likely for them to stick as well. Do know that AWS has a much higher operating margin, which is around 29.6%. So this is much higher than retail, which is single digit. Right now, majority of the company's revenue still came from e-commerce. So with AWS slowly sizing up, we believe it will push the company's operating margin to even higher. The last point I want to add is advertising. We believe advertising remains a great growth opportunity. Advertising has been growing strongly at double-digit year-on-year. Amazon has been trying to improve their ads relevancy, which will drive up the ROI for the advertisers. They're in pretty good position to do so as Amazon is able to collect its first-hand party data. So they have also tried monetizing through ads. They're seeking more ways to expand their revenue stream. So they recently started charging ads in Prime Video unless you pay a fee of $3 to filter out the ad. There's still a lot of room to grow as advertising only contributes to 8% of the company's total revenue. And it's something that we feel has the ability to scale alongside its retail business. To sum up, we're pretty bullish on both retail and AWS segment of Amazon. We also think that advertising can be a good growth opportunity. So overall, we think Amazon has a pretty compelling profitability narrative, and hence we maintain our buy recommendation with a target price of $215 US. That's all from me. Now I'll pass my time to my colleague to talk about the Singapore strategy.
Hey, thanks, Helena. So we'll just go through the different sectors and our recommendations. So I'll start off with the banks firstly. We have OCBC and UOB. I'll speak more about DBS later. So for OCBC, we do like it. We have a buy recommendation with a target price of $14.96. And this is mainly from, why do we like it? It's mainly due to their highest CET1 ratio of 15.9%. So it's the highest amongst the three banks. Let me just explain what CET1 ratio is. CET1 is Common Equity Tier 1, and this is basically their highest quality capital. And the banks tend to like to have it around 12.5% to 13.5%. So that's the optimal range to ensure that they are spending and they're not keeping too much capital, right? So for OCBC, their capital has always been, at least for the past few years, they have always been the highest, right? And there are two ways that a bank can sort of lower this to the optimal range is by making acquisitions, which is what both DBS and UOB have done with their CT acquisitions, or they have increased their, or they do increase their dividends, which is what DBS has done as well. And actually all the banks have done it, right? But DBS is the most aggressive. So with OCBC, they have sort of alluded to a minimum dividend payout ratio of 50%. They're not saying that it's going to be any higher, but they're just saying that is their base. They will not go lower than 50% dividend payout ratio. So we do see that there's some upside to their dividends moving forward, because they do need to lower their CET1 ratio. They have done some small acquisitions, but I guess it is not enough to really make a dent in this 15.9% which they have. So that's why we like OCBC. And also, for them to hit the same dividend yield as DBS, I think it will only lower their CET1 ratio slightly to around 15%. So actually, it's not much for them to further increase their dividends. So for UOB, we also do like UOB with a buy call and a target price of $34.90. However, it's the least liked amongst the three for us, mainly due to they're very strict with their dividend policy. They're saying that it's at 50%. So they are moving forward. They're not going to increase it. They're unlike OCBC. They say minimum, but UOB says that 50%, and that is it. Yeah. So, however, we still like it because they do have the highest growth expected amongst the three banks, around high single digit as compared to low to mid single digit for the other two. And this is coming from mainly their stable NIMs, as well as some loan recovery in the rest of ASEAN, and fee income growth from their cards, as well as their wealth management fee income. And this is coming mainly from their growth in ASEAN, as they are trying to expand further into the region, and also they're banking on their CT acquisitions, which is mostly in ASEAN. Yeah, so there's the few reasons why we do like UOB. And with a baseline growth in their earnings, we could also see absolute growth in their dividend, absolute dividends. However, their dividend payout ratio may not change as much. And yeah, that's all we have for the banks. I'll hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, so for the hospitality REITs, we recommend two subsectors. So one of it is hospitality, the other one is retail. So for hospitality, we like it because we believe that the RevPAR growth potential is still there, especially from the increasing international visitor arrivals. Like since the pandemic, now international visitor arrivals are at post-pandemic highs, and the return of Chinese travelers are also coming back in full swing, especially since the 30-day visa-free travel between China and Singapore started in February, the 9th of February. Yeah, so these are factors, and as well as in Singapore specifically, the RevPAR, like for all the big major concerts and the MICE events, like your Coldplay, Ed Sheeran, Taylor Swift, like IU over the weekend. Yeah, so all these will help to benefit RevPAR and international visitor arrivals as well. So for the recommendations, first of all, we have CapitaLand Escort Trust. So for Escort, this is a very geographically diversified play. They have assets all over the world. And for them, RevPAR continues to improve across all markets. And most markets, in most of the markets, the average daily room rates are already higher than pre-COVID levels, except for China and Vietnam. So China and Vietnam, they've been improving, but just not quite there yet at pre-COVID levels. But we think sooner or later it will surpass those levels. So for them, we expect RevPAR to continue to improve. And on top of that, on their balance sheet, they still have 300 million of past or previous divestment gains that are sitting in the books that yet to be distributed. So they can just distribute partially or part of these gains, like in a situation where some of their properties, they take it out for perhaps redevelopment or refurbishment. So there'll be some downtime. So they've indicated that they will use some of these divestment gains to offset the loss of income. And they also have a commendable portfolio recycling track record, meaning that in the past they have divested assets at a good double-digit, over 20% valuation, over 20% premium to valuations, and at an exit cap rate of around 4%, while they also acquired assets at a higher yield of about 6%. So basically, they are selling high and buying lower. Yeah, if you understand what I'm trying to say. Yeah. So next we have FICE Hospitality Trust. So this is more of a pure play Singapore focused REIT in the hospitality sector. So they will directly benefit from the RevPAR improvement in Singapore. So for them, occupancy rate and ADR continues to trend higher, and they also have similar to Escort, they also have some divestment gains from Central Square that they're sitting in the books, so they also can use to top up their DPU. Yeah, so for 5 hospitality trusts, that is covered by my colleague Miao Miao. Yeah, so next slide, please. Yeah, so for retail REIT, we still favor the retail REIT space because first of all, the supply that is incoming to the market is only the 3-year supply, average 3-year supply is only 1/3 of the past 10 years average supply. So because of the limited supply, we think the demand will still be robust for leasing, and we think that positive rental reversions will still be in place for the next 1 or 2 years. So this is mainly because of resilient tenant sales. So some factors that help the tenant sales are the improvement, rather the increase in international visitor arrivals, as well as the higher population growth in Singapore, as well as CDC vouchers and some of government payouts like NS Life credits. Also, all these will help with the retail spending. So the outlook for tenant sales from the tenant's perspective is still very positive. So they're willing to pay higher rents. Yeah, so from that perspective, that's why we like retail REITs, and we have some recommendations here. So first of all is Fair Centrepoint Trust. So this is a pure play suburban retail REIT space. So right now it has almost 100% occupancy, and they just got included into the STI. And right now their occupancy cost is around very healthy levels at 15.5%. So this is slightly lower than the historical average of about 16-17%. So basically occupancy cost it just means the rental that they pay over the tenant sales. So right now is on the lower end, so they're willing to increase. Tenants are willing to pay more to, or rather, when doing the negotiations, they are willing to pay for higher rents. And next we have a land lease REIT. So a land lease REIT, they have stable use from suburban malls. So the suburban mall gems and upside from central malls and 313. So the central malls will benefit most from recovery of international visitor arrivals. And they also have a potential divestment of the Sky Complex in Italy, and to keep gearing low. And for Suntec REIT, the main reason why we like Suntec is because it's trading at a price to NAV of 0.5 times. So most of the Singapore REITs, they are trading at a higher price to NAV as compared to the overseas REITs, probably because of the risk of valuation declines. Like we saw in Singapore over the past year, cap rates remain relatively stable despite the rising interest rates as compared to overseas assets. And that is also a part of the reason why some of the REITs with overseas assets are trading at a steeper discount price to NAV wise compared to the Singapore REITs. So for Suntec REIT, which is mainly Singapore assets, so for them to be trading at 0.5 price to NAV, we think that is cheap. And they also have a very low fixed rate portion of loans. So any potential interest rate cuts, they will benefit immediately from the fact that they are just a low fixed rate. Yeah, so that's all for the REIT recommendations. I'll hand over time to Peggy to talk about conglomerates. Thanks.
Thank you, Darren. Okay. I cover the conglomerates. Basically two companies here that we under our coverage, Keppel and Sembcorp. They are both in fact power generation company. For Keppel, about 2/3 of their profit is derived from sale of energy, and Sembcorp is also above 60%. So this the power generation gives them a very stable and recurring cost base, recurring income for the two. For Keppel, there's an added attraction in that they are aggressively monetizing their assets, recycling the capital. The objective is to raise their ROE, and the recycling with as they recycle, they also put some of these assets, inject them into the fund under management, and from then on they continue to earn recurring fee income from for the business, for fund management business. So there's two bites of the cherry. Well, Sembcorp, despite the compared to a year ago, the share price already up 25%, but still we think there's some more room for the share price appreciation as they grow the renewable energy capacity. They are increasingly growing this capacity together with third-party partners, i.e. with the capital from third parties as well. So although these renewable energies that tend to give a lower ROE of about 10% compared to the traditional about 15%, still because the renewable energy projects tends to attract a higher pricing multiples, overall we think there will be an uplift in the SCI share price from this renewable space. Thank you. Next slide, please. For the building material sector, there are several steel rebars providers in the Singapore market. But we particularly is positive on BRC Asia, mainly because it is a market leader. We estimate they have about 80 to 90% of the steel rebars market in Singapore. And rebars are essential for both building tall buildings as well as infrastructure projects. And a lot of deployment is usually in the middle stages of a development work. And in 24-25, a lot of this work is actually reaching these phases. So the rebars consumption will increase. We think about the HDB ramping up 20,000 units every year from now to 2025, and the Singapore infrastructure projects like the airport and the underground and the tunnels and expressways. There will be a lot more demand for rebars going forward. And compared to the freight rates a year ago, it has come off as shipping costs are lower, and that helps in their margins. The concern that we had last year over the possible default from some of the construction companies have also been largely behind us now, with the construction sector is more stronger as the construction companies have already completed most of their low margin legacy projects. Okay. On the Pan United, also market leader for ready-mix concrete, as they have about 40% market share in Singapore. The one added attraction of Pan United is the low carbon concrete solutions which they develop in-house. These solutions has already been deployed by PSA and by the CapitaLand Group, not only just in Singapore, but CapitaLand has also bring these solutions to their projects in overseas, such as in Vietnam. So as more deployment takes place, we think that there's a greater market acceptance for these products as the industry moves towards sustainable solutions for the environment. So for these low carbon solutions, we think it will be a key differentiator to differentiate and sets Pan United apart from its competitors in the ready-mix concrete segment. Okay, next slide, please. So for air transportation, we still have a reduced call for both SIA and SETS, although the share price now is probably very near about just 5% or so to our target price. So the price has already corrected somewhat over the last 6 months. I think the market is fully aware of the industry capacity expansion that is coming through, and the expansion has two negatives for the sector. One is it just lowers the airfare across the board for everyone. It is also probably raise the lower the load factors, as well as it find as passengers have more choices, you find it difficult to fill seats on your aircraft. And on the other hand, your cost will, the airlines will also face cost pressure as they compete for more parking slots in the airport, and they also for the staff and all other contract services that they engage. So margins will come under pressure. Then the recent geopolitical events and the natural incidents such as the war in Ukraine, Middle East, even volcano eruptions and the Boeing incidents have all added on to disruptions, and disruption is a major cost item which is where the airlines frequently find it difficult to avoid. So for the same reason, we have a reduced call on sets. Besides the cost pressure, they also have a higher debt which they need to take care of, and there's another 850 million Sing dollar debt that needs to be refinanced by May this year. Thank you. I'll pass on to Paul. Thank you.
Yeah, thanks, Peggy. So I'll just run through some of our consumer names. I only have two, Thai Bev and also Sheng Siong. Thai Bev, we'll talk about it later. So for Sheng Siong, we have accumulate. There was a chat on the difference between buy and accumulate. So buy usually means upside of 20% or more, and accumulate is I think 10 to 20%. If I should know this, I say between 10 to 15%. So we base our recommendations based on the amount of upside to the target price. So for us, we recently downgraded Sheng Siong more because it's still a very incredible franchise. I think they have the industry leading gross margins, about 30%. But what we think is just that a bit slower growth in the near term. What we will see is there's more dining at home because households are facing a cumulative pressure of inflation, not just 1 year. So they do see more dining at home. But what will dampen earnings is the lack of new stores. So they have 70 stores. In the past, they used to grow stores maybe as much as 7 to 8%, depending on the year. But if you average it out, 7 8%. Right now, you're going into 2 to 3%. So that is a slower pace. Together with supermarket sales maybe growing 1 to 3%. So you're talking about maybe 5% revenue type of growth. And gross margins, although that's the problem is when your industry reading, the ability to grow more is a bit tougher. So a bit troughing there. So that's why we think in the near term, Sheng Siong will be a bit slower. So that's why we downgrade. Of course, the franchise is still extremely strong. And they still hold, I think, 300 over million cash, which I think the newspapers mentioned some shareholders as a complaint. But anyway, next slide. So for me, healthcare. So for healthcare, we have Raffles Medical. Extremely cautious because we think this year the earnings will be weak, 24. One of the reasons is in 2023, last year, they still benefit from high margin, this thing called TCF, not traditional medicine, but it's a transitional care facility, which is essentially a temporary hospital. Because what the public hospitals were facing a bed crunch. So as a result of that, you have to put the patient somewhere. So they set up this temporary transitional care or temporary hospitals for these extra patients. Like for Raffles, they have it in Changi. The margins were really good, but then now competition start to come in. So the last bidding, I think prices came down almost, recollect, probably have more than 40-50%. And you can see there were a lot of bidders. I think 7 to 8 people were bidding. Some probably never run a hospital, but they also went and bid. So the margin shrunk for that. The second thing is happening is that for the first time, they also mentioned competition, and that the probably foreign patients most likely can decline, because at best flat means most likely decline. So that's another pressure point. And China startup losses. So China actually opened in the pandemic. They didn't really take on the huge amount of costs yet. So right now is the real probably the second year of full year operation, and they usually guide EBITDA loss of maybe 10 million. So that's why you're going to face a lot of pressure for them. It's still a good stock. I mean, the valuation are still attractive. You're talking about maybe high teens company, and hospitals can sell as much as 50 times PE. Some of the transactions a few years ago, I'm not sure now, but unless you want the value, you are comfortable to holding it for the long term, then otherwise right now we think near term is soft. So for Q&M Dental, we have a buy mainly because we think it's a recovery. So if you dial back a bit, the last 3 years up to 2022, they actually expanded very aggressively. One of the fastest, I think they grew their number of clinics maybe 30-40%. And this is the most aggressive they've ever been. But then now they are consolidating because they need to fill up all you expand, but you still need to fill up with patients. So they're doing that. And the other thing that's assisting them is, I think on Saturday, we went for their launch. They got this AI launch. So what it means is that they are launching this software and they're going to sell it outside the Q&M group. So it will help with this software, the patients can actually detect what type of treatment can actually get from the software will recommend a particular treatment for them. This is also helping them, even before selling, it's also helping them to address any under treatments. That means instead of just patching, you should actually do something more severe, which is better for the patients. So that's also helping them bring up the margins. Last one for medical is Hyphens Pharma. So Hyphens Pharma, they own Ocean Health. They have their own branded healthcare like TDF. Most of the earnings come from this thing called specialty pharma, basically selling more like procedural kind of drugs. When you want to do X-ray, you need that kind of liquid and so forth. And let's give you an example to doctors. So most of the margins come from there, but the longer term growth for them is to build up proprietary brands, which is still not enough scale. So the specialty pharma has more margins than their own branded, which is a bit counterintuitive because your own branded product you should have more margins, but because you don't have scale. So imagine you don't have scale, your as a distributor, you earn more than doing your own brands, which means that a foreign competitor can have so much margins that they can even give to distributors more than you yourself, your own self. So it takes time to build. They're trading about maybe 8 times PE forward, so it's still cheap in a sense. But you're looking at maybe low teens growth because it takes time to build this business. Next slide. Next one is CDL. So I'm on behalf of Darren. So CDL is still attractive for us because of the RNAV is cheap. Of course, can be cheap again for another 10 years. But what we do see is that operationally also they are also growing because the hospitality business is recovering, and also they are building a fund management franchise. It's a bit late because remember they wanted to actually do a REIT in UK, but then the pandemic happened, so maybe they're a bit late. But they are still pursuing this into different type of assets, not just hotels, but they're also building this rented business in the UK. And we also like it because we do see some gradual recovery in residential demand as they are hitting troughs right now. For PropNex, we have accumulated. We think this year will definitely be a growth year for them because last year was pretty bad, the launches. And this year, they are going to see a launch from maybe 7,000 units last year to maybe 11,000 units. It will be good for a real estate agent because you got more units to sell. Not so sure whether it's good for a developer, but definitely good for a real estate agent. There's also going to be a huge amount of completions which will help in the resale market for PropNex. And the most important is the resilient upgrading. So most important is the upgrading cycle. To kickstart people buying private, you need upgrader market to be healthy. So HDB prices is still rising. They're still getting grants from the government as much as 80,000 power, I guess. And PropNex still paying a dividend yield of 7%. And those who may have really heard it because sorry, but PropNex always wants to keep a high dividend for the stock. So they pay dividend maybe 50 million from their own profits, but at the same time they actually have another 140 million on the balance sheet to patch up. If there's not enough, they can always just patch it up. So they got more than enough to support the 7% yield. Next slide. So for telcos, apart from Singtel, which we'll discuss later, we do have NetLink. So NetLink is very boring stock. It's going to continue to grow maybe 1-2% because they collect that $13 plus from 1.4 million Singapore households. So that's recurrent. The yield is 6%, so it's going to be stable. The only thing to worry about is maybe in 2026, because they have this loan of 500 million that they borrowed at 1%, which is probably better than a government rate. So they borrowed at the very low, so it's the amazing thing they did. But once this thing gets refinanced, then depending on where interest rates stand, they could see a 7% decline in their dividend. But at the same time, do note that this is a business trust. So if they want to pay more, they can just borrow. So this is just something to note. For StarHub, they committed to a 6% dividend yield. So it's committed. That means it's, I'm just kidding here, but like sign in blood, they're going to pay you 6%. For us to get the big re-rating for this stock is really after spending that 300 million on their past restructuring. That means, in a way, kind of clean up the IT system. Whether can they get the benefit? Cost is more clearer, but whether can they get the revenue, which again we're not sure. I mean, like who's going to spend more on their mobile phone? I'm not sure, or pay TV. So that's the challenge for us. But and then the third point is that they have a hidden jewel, which is their cybersecurity arm and Simon, which not reflected in valuations yet. But I think until they hit something more, they scale their business up, then and do some monetization efforts, then maybe you could see some re-rating for them. Next slide. So last one, electronics. So for me, it's venture. I know venture went up probably a lot of, and the market's probably upgraded, but for us, we're still cautious. We think the guidance that they gave in the end of was still a very cautious. So that's why we're a bit hesitant to upgrade this stock. Again, everyone's in the dark for this stock, like who's exactly their customers. But for us, but they still pay a 5% yield, and it's a stock to hold, but you're waiting for a recovery because they have a 1 billion cash in hand. Next slide. So I'll move on to our usual absolute 10 stock picks. So in terms of our model portfolio, we added Cromwell and DBS. We took out Fraser Centrepoint and OC. Since Fraser Centrepoint already entered the STI, we're just thinking like how much more upside can they get? I mean, the near term. OCBC, because DBS has a pays a more attractive dividend, which Glenn will highlight later. Next slide. Sorry, just to go around on this slide. Sorry, the one that hurt us the most, the portfolio, which we'll discuss, and then will be the Thai BEV and also Capital Land Investments. You can see here down 15 and down 7. Next slide. This is just for illustration. We just show this. The blue line is the portfolio, and the green line, again, this for illustration, we exclude brokerage, we escape rebalancing costs, we escape dividend that is, we usually go for dividend, but we also exclude that to kind of offset everything. Next slide. So for Comfort, I know everybody heard this, so I won't go delve too long. We still think Comfort is under-earning. Under-earning means they have not earned back to their pre-pandemic levels, which you can see from here on the left, about 300 million plus. And we still think it'll be another year of growth for Comfort, mainly for the Singapore taxi. You will notice Singapore taxi growth now comes from the platform. So they're no longer going to increase the rental, but they're going to turn more like a Grab-like, but profitable Grab. Grab is profit depending on how they want to measure. But for them, they are focusing on profitability through the platform. So number one, they introduced platform fee of 70 cents per booking in June last year. So you still get the 6 months. And they raised their commission from 5 to 7, which is still very low. I mean, 7% compared to some of the other platforms charging 20% or even sometimes 30%. So that room to, and that they only raised it in January of this year. So you're going to get the 12 months. Second growth driver is China, which is surprising. I mean, China, because China, you need a license to do ride hailing, and the fleet there is growing. So they're actually expanding their fleet in China. The third thing is the rail business, which we think makes, I think amazingly, we think makes less than 1 million, our own estimate. Because there's a lag. When they charge everything, there's a lag. So we think they will get some of the benefits this year because they have to face a lot of electricity costs just to cover the expense. The fourth one will come from the UK, because UK was hit badly in 2022. Because of the inflation, there was a bus strike. They had to raise all the passengers, and they only get to recover with inflation indexing pricing annually last year and another one this year. And the big one would be the recontracting. Because all of these contracts you have to recontract and every 5 years, so you get the benefit. Because competition now, since everybody got hit so badly, so competition is abated. So they're even guiding from the current mid-single digit to now low teens type of margins in terms of the bidding activity. So that will also reflect. And then once you lock that in, you get the benefit for 5 years. And of course, the chart here also shows the balance sheet also recovered from the pre-pandemic net cash of 60 million to net cash of about 500 million right now. Next slide. The other one is Thai BEV. So Thai BEV, one of the weaknesses is because the whole Thai market was the worst in the first quarter. I think worse than China. Of course, I'm also giving an excuse. I mean, just to find some excuse why the thing performed so badly. But having said that, we are still waiting for a better macro for Thailand to recover, and hopefully the new digital wallet, the 13 billion spending they're going to do to give each individual adult to spend on household stuff. And also the second thing is hopefully after that, then Vietnam can recover from a better macro. It's more a macro call again, like we highlighted before. Next slide. Second last one for me is Singtel. So Singtel, we think there are a few share price drivers. So we just put them down so easier for you to identify. Firstly, they're still committed to a 4 billion disposal. Some of it is the comm center, the Somerset comm center. They'll develop it into a property, then they inject the land, then the developer will inject money, then they can recognize some of the gains there. Of course, they also sold, there'll be some stake sale too. The other one is, of course, they still collect like 1.4 billion of dividends from the mobile associates, which can still grow because there is still pricing increase. That means the mobile prices in the associates like Indonesia, India especially, are all still rising. The important one is the cost cutting. So the results comes out important for them to show the Optus cost cutting. So they're looking to cut costs 600 million or 200 million a year. The one that is a bit of an unknown now is the NVIDIA GPU. So they're working with NVIDIA to set up pure GPU. That means the data center only GPU, because the current data center cannot accommodate because there's not enough power. So this is 100 watt. How much revenue they can generate, EBITDA, it's up in the air, but that's to give you some simple computation. If you take, let's say, 100 megawatt capacity, what you can actually charge, depending on that so-called PUC or efficiency thing, you probably can charge maybe, let's say 80 megawatt. Then from the 80 megawatt, you work backwards. Maybe they can charge $2 to even $3 per kilowatt. Then you take a margin spread away, maybe 50%, 80%, depending what you want. Then you could actually get a few $100 million. Again, I'm speculating here because there's no guidance. So you can get a kicker in the earnings with this NVIDIA GPU service, something that what YTL is also doing. Power. Yeah. Next slide. Finally, for me, you'll probably hear me talking about this again, but for Valuetronics, so we're waiting for the re-rating because the last 5 years earnings disappointed, number one. So, but we think with the 4 new customers they announced, they will rebound. Number 2 is, of course, the valuations. They are trading close to net cash. So the blue line is the market cap. The red line is cash. So I put the red line here just to show you the cash is there all along. Only 2019 it dipped because they had to do the new Vietnam plant. But that cash has been there, the 1 billion Hong Kong dollars, which they are using to pay dividends and also to do share buyback. So when the first half results was up 40%, so we think hopefully when the second half results is strong, then you might get the big re-rating for this stock. Because it's a small mid-cap stock anyway. Okay, I think that's it for me. I'll hand it over to Glenn. Thank you.
Hey, thanks, Paul. Yeah, so for us, for the banks, our topic will be the DBS, and mainly due to the title. As the title says, dividend yield has reached a record high, and it's also the highest amongst the 3 banks. Yeah, just to clarify, I think someone asked also in the Q&A, what happened to the DBS share price this morning? Yeah, it's mainly due to their bonus share issue. So what happened, just explain it very briefly, in simple terms, is that when they issued the bonus share issue, they issued 1 for every 10 existing shares. So basically the denominator increased. So the base increased by 10%. Hence the share price actually dropped by 10%. But for those existing shareholders, you don't really feel the difference. You still have the same amount and same value of your shares. Yeah. So let me move forward with DBS and why we like it. Mainly due to their high dividends. So even though they are even with if you include this 1 for 10 bonus share issue and the dividends increase that they are saying every 24 cents every year, we're looking at around, I think it's now 6.5 to 6.6% dividend yield, and that is the highest amongst the 3 banks. And also they are very clear with their guidance on how much they're going to increase every year, whereas the other 2 banks, I guess they are not as, maybe they are clear, but they don't really say they're going to increase it by this amount every year. And how are they going to, the main question is, how are they going to maintain this strong dividend growth, and if they can even do it? So yes, firstly, you look at the 3 main segments, I would say they are their net interest income segment. So if you look at net interest income, they are expecting that net interest margins will probably lower slightly, mainly due to the expected rate cuts, but this will be sort of offset by the loans growth. And you'll see sort of a balance there. So they are expecting net interest income to be rather stable or flat. And secondly, they're also looking at their fee income growth, and this will be coming from their wealth management fee income, which will be supported by their Citi Taiwan acquisition. So Citi Taiwan has actually added around $10 billion to their loan portfolio, and it's also quite a large proportion, large increase to their wealth management fee income, as well as their wealth management AUM, or assets under management. So assets under management for the wealth management side has also increased by around 23% year on year in FY23. However, the income they receive from this larger base actually has not increased much. This is mainly due to the markets. So as markets have started to improve, and they also expecting for them, with the rates going down, more investors, maybe those high net worth ones, will move their funds away from like fixed deposits into their interest earning sort of wealth management side, and this is where they can earn a higher spread. So this is how they are looking to continue to grow their wealth management fee income. Yes, and yeah, so that's all I have for DBS. We do have a buy call, and the current target price of $38.90. Yeah, so that's all I have for the banks. I'll hand it over to Darren for the REITs. Thank you.
Yeah, so for the REITs, we Cromwell European REIT, so we recently initiated this stock. So we like it for a few reasons. So one of it is a very resilient portfolio of logistics and office assets in Europe. So right now their portfolio occupancy is about 95%, and they have generated 6 consecutive half of positive rental reversions. So the most recent second half 2023, the portfolio rental reversions was about 5%. So that is one of the reasons. Another reason is that the CPI, that their leases are all CPI linked or CPI indexed, has escalations based on that. So in periods of high inflation like last year and this year as well, even though inflation is slowing, there will still be some solid rental escalations in the portfolio. So the other reason is that basically they have a divestment plan to keep their gearing within healthy levels of under 40%. So this divestment plan is about 400 million euros worth of assets. So this plan was started in 2022. So since then, they've already divested about 270. So they divested this at a premium of about 14% to the most recent valuation. And going forward, they have another 160 million euros that are up for divestments. And these are mainly from the weaker Polish and Finnish office assets, where they're grade B and grade C. So proceeds from these divestments, they can use to pay off the debt. So currently the debt, they have no loans that are due for refinancing in 2024. The nearest one that is due for refinancing is in 2025 November. So that is a 500 million euro bond that they've already bought back 50 million of it. So their capital management, they're taking a very proactive stance, which is why we like them and we think that they will not have any issues with refinancing this loan. So for this slide is a DPU growth, or rather DPU expectations. So as I mentioned that they have already divested some significant assets in FY23. So for FY24, due to the loss of income from these divestments and expected further losses as they divest more assets over the course of the year, we expect that DPU will drop to 13.76 this year. But despite this 13.76 decline, Cromwell, based on this FY24 estimate, is still paying a dividend yield of 10%. So we think this is attractive. The only downside for Cromwell is that you'll be exposed to the FX risk, the foreign exchange risk, as their income that they collect is all in euro, and they also pay in euros. Yeah, so that's for Cromwell European REIT. Next slide, please. Sorry. So excuse me. Next is CLI. So for CLI, the first quarter performance wasn't too good, as Paul mentioned earlier, the share price performance. So that's mainly because of the weaker China real estate business in China. So that is affected, but will probably recover over the course of the next 2 years. So, but the reason why we like CLI is mainly because of their recurring fee income business. So that for the recurring fee income business, they have right now about 90 billion of funds under management. So they have 10 billion that are already pre-committed, but they've yet to be deployed. So they have a target to hit 200 billion funds under management in the next 5 years. So if they manage to do so, their fee income effectively would be able to double for this particular part of this business. So they also benefit from the improvement in lodging. So in FY23, their lodging fee income they managed to grow by about 30%. So the improvement in RevPAR and global travel recovery and such all help with this lodging fee income business. And the thing for them is that they are still affected by the high interest rates, as I mean all companies are, but for them they're especially affected because for high interest rates, it's really challenging for them to raise funds to increase its FUM as well as to deploy funds. And for them, they have about 9 billion of assets that are still sitting in the books that they are up for divestment, about half of it from China. So because of the high interest rate environment is quite, they're basically, the transactions market is still weak and there are not many buyers, and not many buyers are willing to pay that high price, which is why it's challenging to divest, and as a result, lower divestment gains. And also for the events-driven fees also, in the absence of these divestments, and acquisitions, rather, they will also have no, or rather much lower event-driven fees. But we expect these event-driven fees and divestments to pick up perhaps later half of this year or 2025. So yeah, this will benefit CLI. So basically, we like CLI for their recurring fund income, recurring and stable fee income streams from private funds, listed funds, as well as the lodging business, and as well as commercial management. Yeah, so we have a buy on CLI with a TP of $3.38. Yep, that's all. I'll hand over time to Peggy. Thanks.
Thank you, Darren. Okay. Further elaboration on Keppel. Besides the power business, which will contribute about 2/3 of its earnings and provides a stable stream of income. What to look out for Keppel in the short term for the share price catalyst is, is that we expect them to be receiving about 4.3 billion as they recover from the notes receivable. Well, some background on this notes receivable. When they sell the Keppel O&M to Sembcorp Marine, which is now Seastream, there are some legacy rig assets which are divested into a fund, and then with that, in return, they get a 4.3 billion worth of notes receivable. With the stronger oil prices, and in the last 1 year, we've seen very good recovery in the day rates. Although there's some a little bit of crack there. We think that all these rigs are now fully deployed, and we think Keppel will speed up the disposal of these rigs, and this 4.3 billion could come back to Keppel in the short term. In the medium term, Keppel has targeted 12.6 billion worth of assets in its balance sheet, out of a total of 68 billion, which could be monetized. This, of course, includes a lot of it is real estate, which for the last few monetization efforts were mostly real estates. But in this 12.6 billion, we also identified 2 billion worth of data centers held at the Keppel group level, and some infrastructure assets, including the water desalination plant, and of course M1. So this is something that we could look forward to for Keppel. And this 12.6 billion, part of these assets could be injected into the fund under management under Keppel, and Keppel has a target to raise its fund under management to $200 billion by 2030. And right now they have hit the 77 billion mark. So this 200 billion looks achievable. And with this fund under management, they will generate fee income, which is calculated as a percentage of the FUM. So then that will add another layer of recurring income for Keppel. Thank you. Next slide, please. So ST Engineering is also in our absolute 10. Why we like the company is strength in the defense and cybersecurity. About more than 60% of its EBIT, earnings before interest and tax, comes from defense and security. And this segment is also the segment that commands the highest margin of 13% EBIT margin. So we think this is the segment that will grow because of this rising geopolitical tensions in Middle East and as well as Russia and Ukraine. I pull out this graph to show you the world defense budget spending, which the countries have all they announce what they want to spend, how much they think they want to spend. So in 2023, they projected a 4.7% increase in the defense budget, but in the end, the actual spending turned out to be 9% higher compared to 2022. So similarly, for the next 5 years, they have indicated spending every year of 4.9% growth. We think this will again be higher than what they say they will do. So therefore, that will underpin the orders for ST Engineering going forward. Thank you. Next slide, please. With China Aviation Oil, it's not so evident going by the news flow that we have, negative news flow for China. But the data tell us otherwise. We pull the data from the China Aviation Authority for all the international traffic through all the China airports. It's now at our latest data in February, it's only 18% below the pre-pandemic level for passenger travel. And for cargo, it's in fact 71% higher than the pre-pandemic level. This shows that even though the flights between US and China has not recovered, it's only down right now about just 20% of the pre-pandemic level. But the flights between China and the rest of the world, like in particular US, Middle East and Europe, has been growing very, very strong, very fast. And the recovery has been strong. And with the higher volume, China Aviation Oil supplies jet fuel to the international airports in China, and the dominant share in the 5 key airports in China, plus an exclusive right to supply international flights out of Shanghai Pudong Airport. So we expect volume to grow, and as volume grow, China Aviation Oil is able to not rely on back-to-back contracts, but now increasing the products share in terms of the end-to-end contracts directly between taking the supply from the refineries and deliver directly to the airline customers. So an end-to-end contract will help them to boost their margins from this year onwards. Thank you. That's all for me. I pass back on. I think. Oh, sorry, no, it's me again. Okay. The recent acquisition, we have Thomson Medical. Okay. I've received many queries when I put up this report. So I think this chart will probably show where my conviction lies. Thomson at the end of last year, December 2023, their year end is June. At the end of 2023, December 2023, they bought a stake in the Vietnam hospital, short for FV Hospital. Okay, FV, so in FY24 is a half-year contribution from FV. But when you see a full-year contribution from FV, it will bring Thomson's revenue and profit back even above the FY22 level. So every will be more than every together with the Malaysian operations, which is growing very nicely, will more than offset the decline in Singapore operation due to the absence of or the decline in the number of foreign patients coming to Singapore. So the foreign patients in Singapore has been mostly been Vietnamese and Indonesian, possibly of Middle Eastern and Chinese. So the Vietnamese patients during COVID has not be able to travel. When they stay back to seek treatment in their home country, they found that the standard of care and the scope of services is just as good. And seeking treatment in the local country cuts down on their cost, the accommodation cost. They no longer need to have a translator to move around with them in the Singapore, like what they did in the Singapore hospitals. So the Vietnam hospital has been growing nicely in terms of getting their own domestic patients as well as foreign patients even coming from Thailand and the neighboring Laos. So the Vietnam hospitals acquisition is a very strategic move for them to be able to expand their footprint in the Asian markets, ASEAN markets for a start, and then ultimately it will be able to broaden its exposure to a bigger population in the bigger countries of Vietnam and maybe even Indonesia. Thank you. Next slide, please. So for valuation wise, we break up the and we use the SOTP valuation model, and these are the values that based on EV to EBITDA, we achieve these valuations for Thomson. There's a column here, Iskandar. Thomson has been trading at a higher valuation in terms of PE ratios compared to its peers, mainly because in his books it has this 1 million square feet of Iskandar land, freehold land, which is now ready to restart redevelopment, as it was held back during COVID. And the land cost of 100 million is captured in this book, and also the interest cost, which has been which is bringing down its profits. So with the development of Iskandar, we use just a very conservative value for residential, which is now, I think it's now high about I was told like 20% higher than my per square foot assumptions. So my value is a 1.1 B for the Iskandar land. So net of the net debt that is in the books of 335 million, we think there's a value unlock of 363 million for potential value unlock for Thomson Medical. And with the EV coming into contribution, and higher contribution from Malaysia, the healthcare is very strong, generates very strong cash flow for Thomson Medical. So we see a potential decline in the net debt as well as a progressive contribution from the Vietnam and Malaysia becoming bigger. That's the reason for our recommendation buy call for Thomson. I'll pass this on to Miao to talk about 179. Thank you.
Thank you, Peggy. We initiated on 17 Live. It's a live streaming platform listed on SGX, so taking over Vertex Technology, the SPAC. Some pictures are here. A majority of the income is generated from live streaming, but we actually believe WeLever will have a huge growth potential. So instead of the real person showing the streamer's normal face, WeLever is the customized animated face. So it's called skin, and one skin used to cost 1,000 to 2,000 US dollar and takes weeks to generate. And now it's almost instant and free of charge. And here are some pictures of the photo of the app. The one on the left is for Southeast Asia, and the one on the right is for Japan. There's more animated stuff for Japan side. And we like the company mainly because we believe they are capable of further monetizing on their core user base and streamlining some operating expense from FY24 onwards to improve profitability. Revenue is for the company is mainly generated through selling of the virtual gifts. for both live and VLive streaming. Yeah, so like after declining for 3 consecutive years, we believe revenue from this year onwards will be stabilized. This is mainly because they set a target of improving users' retention rate through introducing more user-friendly functions and also streamers training, such as how to greet your users and how to provide more interesting and engaging content. So we expect MAU monthly active user to grow by 10% organically. And they also shift its focus towards higher margin revenue, such as live commerce. We expect the segment to grow by 40% year-on-year on the back of the increased demand for cross-border products. For Japanese products, for example, now Taiwanese streamers can import and purchase the product from Japan and sell it to Taiwan users. Yeah, and as mentioned, they are also cutting down cost. Around like 15 million R&D expense will be saved this year without compromising users' experience. And 17Life is also constantly reviewing and optimizing users' contract. This is essentially to cut down the revenue sharing portion for streamers. Yeah, and they also observe a phenomenon of cross-border arbitrage for virtual coins. Since in FY23, yen depreciated a lot, so some users choose to purchase the virtual coins in Japan side and spend it in Taiwan side. And they actually implemented some policies to restrict this behavior this year. And altogether with the contract optimization, we are looking at around 10% margin improvement for Taiwan. And finally, we expect some like upside for 17Life through inorganic growth. Since they are currently have 100 million cash in hand, they are eyeing acquisition of new streamers to the platform, but with existing user base. Around 1 new streamers will bring on board additional 20 MAU. So we expect the acquisition to be revenue and MAU accretive. Yeah, so in summary, we expect major revenue driver to come from new content, live commerce, further cost reduction, and also inorganic growth. Yeah, so we have a buy recommendation for 17Life with a target price of $2.3. And that's all for me. I'll hand over back to Paul for conclusion.
Yeah, thanks. So today's session is pretty long, so I'm not going to go through the conclusion. I think we can just go ahead for the Q&A. Yeah, thanks, Mel.
Okay, let me just begin. Yeah, so the first one is comments on Mapletree Industrial REIT, Capital and Ascender Street, please. Yeah, so if you're worried about because this industrial subsector for the first quarter, they're the second worst performer, but that's mainly because it's in FY23 they were the outperformers by quite a bit. So that is just more of a okay. They were outperformers basically in FY23, and then because of the results, we saw some weakness in the US for both Ascender Street and Mapletree. So Mapletree Industrial REIT, their US data center portfolio, the occupancy fell to about 90%, and that's similar to the Capital and Ascender Street's US occupancy of some of the logistics assets as well. So there's a little bit of weakness in the US now. Yeah, so going forward, like we are first quarter, we are monitoring to see whether they can improve this occupancy there, and we are most likely expecting mid-single digit rental reversions for these assets. Yeah, so those are just some quick comments for those two counters.
Do you want to take?
Yeah,
take over?
maybe you can go ahead. Yeah.
Thanks. I see 2 questions for me, so maybe I'll answer that first. Hi Peggy, you seems to have bright picture in the construction industry when talking about BRC and PenU, but a few days ago, CNA reported more construction companies went bust recently. Will that bad news just be the tip of the iceberg and more to come? This is giving me a mixed signal. Yeah, thanks very much for the question. Yeah, we we monitor the construction sector both from the demand and supply angle. Yeah, for BRC and PenU, BRC supplies rebars and PenU supplies ready-mix concrete. For these two products, as if for the public projects, the prices are protected by a fluctuation clause. That means the BCA gives a guidance on the fluctuation clause, and so when there's a share price movements, these suppliers are able to adjust the prices according to that fluctuation clause. That's one thing. Second thing is for these products as well, as soon as they supply, and then the supply has been qualified, that means the engineers on the ground certified that it has been received and approved, then they send out the invoice. The BCA requires that the contractors have to pay them within 21 days. Right, so there's a shorter payment period. The third thing is more than 60% of the construction contracts right now come from the public sector. In public sector, if there's a contract, when they have a design, and then these contracts are now getting bigger. So when they have at the design phase or about to or in the planning phase, they would also, for the bigger projects, they would also involve these building material suppliers. So in that sense, PenU and BRC are directly facing the end customers. In these government contracts, it's such that if for some unfortunate reason the contractors could not make it, the government is the authorities will quickly switch as another contractors to undertake the job. So the risk there again is lower, because the customers is in a better control of the situation, and because they are also in direct conversation with these suppliers, material suppliers, the material suppliers are able to have greater visibility on the structure and the risk relating to the contract. And the final thing is that for these materials makers, sometimes for clients that they are not so certain, they will engage the credit company and secure an insurance on this kind, so that they get paid if the client has some potential of some default. But of course, if that client is really a lousy customer, even the credit company might not want to provide this as insurance. So if they don't provide the insurance, you know that, I mean, these are the best people around to tell you whether the construction companies is healthy or not. So for situation like this, you could also imagine that PRC and PenU will also not want to contract with that customer. So there are a few layers of comfort that we draw. So we see that the resale is much lower compared to the level we've seen 2 years in the last 2 years. Thank you. The next question I have is on sustainable aviation fuel. Will the rise of sustainable aviation fuel usage by airlines globally have any negative impact to China Aviation Oil in the mid to long term? China Aviation Oil is already in a very small scale sourcing SAF, right? But it's a very small scale. But if you think about China alone, right? China is actually already a very much into setting up production facilities to produce SAF. Like China, Sinopec, and all the oil majors have already tied up with the French, the Germans to produce to have SAF production out of their refineries or set up new refineries in China to produce SAF. So I think, and in this sense, China is actually very advanced in this area for SAF usage. And in China, aviation oil is definitely a participant in this area. So we think it will not impact on their supply contracts which they have signed with the international airports in China to provide aviation fuel to these airports for the international flights. Thank you. I think I passed. Oh, sorry. I pass back to the rest first. Thanks.
I think there's one for me regarding DBS. Yeah, so I think it's just asking whether my target price, why my target price has been maintained, and did I have to adjust the target price after the bonus share issue? Yeah, so we are working on that. When it's adjusted, we will update you accordingly. Yeah, thanks. Hope that answers the question. Yeah, so for those that didn't hear earlier, I was just answering another question that was asked, why did the share price for DBS drop so drastically? And it's mainly due to the bonus share which was issued. And they so basically how they did it was they have a 1 for 10. So every 10 shares you have, they will issue 1 share. And what they did was, when they issued that 1 share, the pool of shares increased, but look at the market cap, the value of the shares did not really move. So when your base denominator increases, so when it's divided by a 10% higher base, theoretically speaking, the share price will dip by 10%, which is what it did. But yeah, so hope that answers both of the questions again. Thanks. I'll hand it over to the rest of my colleagues. Thank you.
Yeah, thanks. The questions jump. Sorry. Which subsidiary REITs, FEHG, Escort, CDRHG will be a better position for capital and dividend gain? Yeah, so just looking at the perspective of the DPU growth year on year. So for DPU growth, I would say FEHG has the best potential. That's mainly because on the interest rate perspective, they do not have any loans that are due for refinancing in FY24, which is this year, and Escort is about 13%. CDRHG has about 30%. So when they refinance these loans, we can expect the interest rates to really jump. And in that case, when interest rates jump, basically their DPU will be affected, and the year-on-year growth might be lesser as compared to a REIT that can hold the capital management and interest rate stable. So from that perspective, I would say FEHG will have the most potential for dividend gain. Yeah, please repeat what is occupancy cost. Yeah, so occupancy cost is the income that the tenants pay on a net basis divided by the tenant sales, total tenant sales. So yeah, so that is the occupancy cost. So basically, if a lower number, it means that the income they're paying based on the tenant sales is low, which is why there is room to increase the rents towards a more historically average of rather a higher average occupancy cost, because right now most of the REITs are trading at the occupancy cost is lower than historical averages. Yeah, there's one question. Which has a stronger conviction, buy or accumulate? Yeah, so buy is 20% growth. I think Paul mentioned earlier, buy is more than 20%, and accumulate is 5 to 20% growth. That includes dividends. So yeah, more than 20% is buy, and accumulate is 5 to 15%. And then neutral is plus minus 5. Yeah, then to follow up, there's a question on Escort. Why does it have a buy rating when they have commendable recycling track record? REFA is also up and they still have divestment gains. Yeah, so actually for Escort, we used to have a buy rating all the while, but 2 quarters back they did a fundraising that private placement and equity fundraising. They raised funds in the market, and that resulted in the equity share base increased by about 10%, if I remember correctly. So because of that, our target price dropped from $1.20 over to $1.04. So which was why, as a result, the rating has dropped to accumulate. But as our most recent share price, and probably if you maintain our target price in the upcoming results, it will most likely go back to a buy because of the share price movement recently. Okay, I think I'll hand on over to the rest of my colleagues first. Thanks.
Yeah. Okay. I'll take on a few, then we pass it on to Zain. So, what are your thoughts on Thai Bever's debt levels? So, Thai Bev actually had very minimal debt until 2018. They acquired Sabeco, Saigon Beer for almost roughly, I mean, just round up the number, about 5 billion. Then their debts peaked at 7 billion, then now dropping down to 5 billion plus. They generate about free cash flow roughly 1 billion. Of course, some of it is commingled with Sabeco. Sabeco, they don't actually own the whole thing, but they still generate very strong cash flow to cover the debt. So I'm not too worried. It's just that because of the high debt, the contributions from Sabeco is actually quite negligible to the earnings. So beer is less than 10%. And because whatever earnings they got from Sabeco was used to pay the interest. So it's just that the acquisition hasn't really contributed much. In a way, you think about it. Like if I spend 5 billion, yeah, you earn 5% interest, so you probably make more. Yeah, you probably make like 250 million. You put that 5 billion, but yeah, and you save on the interest expense. So that's the only thing. It's more the income that they are generating from the acquisition from Sabeco. But no, it won't really not a concern because one thing good about consumers, they generate a lot, very strong cash flow. So that's their strength, 1 billion Sing dollar free cash flow every year. I'll answer this last one, then we hand over to Zain. Are there any listed counters in SGX that have exposure to AI sector directly, indirectly? Directly, no. Indirectly, yes. I think indirectly will be, of course, the semiconductor. So if you take, for example, a very indirect, so let me just tell you how indirect it is. So of course, you're NVIDIA GPU. So to make NVIDIA GPU, you need TSMC. Then TSMC, sorry, you have to follow this. So they buy the chips from TSMC, at least the wafers. Then TSMC got to buy equipment from ASML and also Applied. Then Applied have to buy, will also source component parts or full assembled machines from UMS and of course Franken and so forth. So you're talking about 1, 2, 3, or like 4 layers. So if you want the AI, just buy NVIDIA. I mean, that not really a real benefit through. And of course, right now, then Singtel will can capture some of the benefit, but it will be small. I mean, in the whole context of things. So Singtel is a $30 billion market cap company, so very indirect. For pure exposure, and then like I said, let's just go straight to the US and just buy for NVIDIA, because if NVIDIA don't move, you can forget about the whole AI sector. It's like it's not going to move. Okay, I think I hand it over to you, Zain. Thanks.
Okay, thanks, Paul. I'll start with the TA. Okay, so first question is on CLI. I think currently it's trading near close to the all-time lows last week. Some rebound today, but I think near-term wise likely to be still quite weak. Given this very strong downtrend, as well as a recent breakdown of this wedge pattern over here as well. With near-term resistance around the 260 level, likely to be continue to act as a resistance, the recent breakdown. Next one is on Mapletree Pan Asia Commercial Trust. Okay, for Impact, recently the price retested the lows of 120. Some slight rebound, but I think it's probably just a small rebound in this downtrend over here. With resistance around the 127 to about 130 level area currently. Yeah. And as for Asian PATV, when we look at the longer term trend is downwards. But the support around the 0.079, 0.080 level has still been holding for about 4 months. It's still currently trading in this range. So yeah, I think we could still see some range bound movement for some rebound upwards against towards the range resistance at 0.083, 0.084 about that. Okay, next one is on Mapletree Logistics. MLT recently broke down this support at 140, and then price has reached the next support level at 130, which was a prior swing low back in October 2022. So with that, I think we could see some slight rebound, but likely to be still the price action likely to be still quite weak. With current resistance around the about 137, 138 currently. The next one is on Capital DC REIT. Okay, for Capital DC, I think it's quite range bound currently. Support is still around 165 out there. So over here, if that price can rebound, I think it could do a short-term retest of 160, 169 as a short-term resistance. Yeah. So for Capital DC, quite range bound for now. Next one is on Suntec REIT. Okay, for Suntec, I think it still could trade in a bit of a range bound for now. Recently, price retested reached a high about 114, 115. We tested a prior support level breakdown over here, and then price turned back down towards. Currently, it's quite near the support about 104 to about 107, this area over here. So I expect some rebound over here and just some sideways trading thereafter. Okay, the next one is on Capitaland Escort Trust. Capitaland Escort Trust recently some weakness with lower lows being formed. I expect near-term support to hold around the 85 to 86 cents area over here. But in terms of resistance wise, likely to see some resistance of 89 cents to 90 cents for the time being. Yeah, so some slight weakness could persist in the near term. Then in terms of next one is on CDL Hospitality Trust. For CDL Hospitality Trust, I expect some rebound over here from this retest of support, which is around 92 cents to about 94 cents area over here. So yeah, we could see some rebound towards 96 cents, 97 cents area, with the retest of the recent lows formed in February this year. Okay, next one is some US counters. First one is on NVIDIA. Okay, NVIDIA with the sell down last Friday, it broke down this support level around 830, and then also broke through this support at around 775 as well. So I think near term wise, we could still see a bit of a downside to retest this 740 previous horizontal resistance level over here, and as well as there's this gap over here as well. So I think overall still see some downside for NVIDIA with near-term resistance from about 780 to about 800 area. And for AMD, okay, for AMD also still breaking down some levels. Last week broke down below this 151 previous resistance level. So with that, I think the price could still hit a bit lower towards 143 as the next support level. Then the next one below is about around 133, about there as well. Yeah, so still no signs of any bullish momentum coming in to stop the decline. Yeah, still very strong bearish momentum currently. Okay, next one is on Tesla. I think Tesla some continued weakness last week. So the descending wedge support over here, this trend line over here couldn't hold it on Thursday. The 152, 153 level was also a previous swing low back in April last year as well. With that, some continued breakdown recently. I think share price could still go a bit lower towards the next support level will be around 137, about that. Yeah. So we could still see some further pullback for Tesla. Okay, next one is ARM. ARM also had some significant pullback recently. So we very strong bearish momentum. I think currently we're in the middle of feeling this price gap over here after the earnings previously. So I think there's still a chance that could still see some further decline towards like 78 to about 80 area to actually retest this prior range resistance as well as close out this price gap before some rebound could take place. Yeah, then in terms of immediate resistance wise, 94, 95 will be the immediate resistance level. Okay, next one, any upside for sets, Citrum as well as 17 Live. Yeah, take a look at the charts. First page sets. Okay, sets I think undergone quite a bit of decline. Currently still trading in this downtrend channel highlighted in blue. In terms of the downside wise, I think it could currently we tested this 240 support level, but it could still go a bit lower towards maybe like 235, 236 over there, which was the prior range, prior support level over here back in October 22 and March of last year. Yeah. So over here might see some support over with the retest of this channel support as well. So in terms of upside wise, I think if we find some support over here with some bullish candlesticks, then there might be some upside over here. Okay, next one is on Citrum. Citrum, I think there could be some short-term upside. Recently priced did a retest of this 0.076 level. Looks like a double bottom. Today we have a bullish candlestick forming. I think overall it's trading in this descending wedge highlighted in blue. You can break out over here and actually find support from a retest. Then I think there could be some short-term upside. I think in terms of indicators, I also saw there's also some bullish divergence with the higher highs, with the higher lows formed in the indicators as well, while price is currently trending downwards. And next one is on 17 Live. 17 Live, I think in terms of upside wise, I'm not too sure about that. Yeah, so recently price is still testing the $1 level with a lower high resistance form around 110. Then after that, price came back down to test $1 again with a lower low today of 99 cents. So I think there could be still some downside here. Okay, next one is on Google. Sorry. For Google, I think there could be some further pullback ahead if you can't maintain this 153, 154 level over here, which is this uptrend channel support over here, as well as a prior resistance. Yeah, so over here we need to see some bullish candlesticks coming to for this uptrend channel to continue. If not, you might see a lower further pullback towards like 150 and 147 as well. Okay, next one is on Amazon. Okay, Amazon recently broke down this rising wedge pattern over here. Also below this $180 range resistance level. So I think we'll see some downside towards like 172 this range support over here before some rebound takes place. Excuse me for okay, so next one I'll go through about Broadcom. Okay, Broadcom recently some weakness in terms of the the share price. There's a breakdown below this range consolidation between 1,003 to about 1,004. I think recently price also retested first level of support at 1,002. So if this level holds, we might see some slight rebound, but I think overall likely to still find some resistance from the with a lower high about 1,250. In fact, we should find some resistance over there for the time being. Okay, next one is on Samudera shipping. Okay, for Samudera, I think the uptrend is still intact over here. Currently, it's trading this uptrend channel over here. Uptrend channel over here, currently still forming higher highs and higher lows. Yeah, so I think for the uptrend to continue, it should still hold this price level about 84 cents over here. Then, could see a continued rebound to continue the uptrend. Okay, next one is on Franken. Okay, for Franken, I think some weakness currently after the breakdown of this 160 level, we tested the lows at this swing low at 148. Currently price is currently a bit sideways with resistance around 155 about there. I think could still be some downside to retest some lower levels, especially with this downtrend with low high. Next support level that could retest is about 142, 143 over here. And in terms of next one is Sembcorp. Okay, for Sembcorp Industries, I think it's either likely to go a bit sideways or downwards bias for now. Because after the recent pullback from this breakdown of this wedge over here, price retested this previous range resistance about 510, did a rebound, and then found resistance from this 543 level, which was this support level breakdown over here. So with a lower high, I think we can expect to see some price weakness ahead to actually retest the lows of about between 510 to 520 in the near term. Okay, next one is some Hong Kong counters. Okay, so for Meituan, I think Meituan is still looking quite nice. It's still trading in this uptrend channel over here. And then also price actually retested this 96 previous resistance, now acting as support level. So I think we could see some bounce ahead to actually retest the recent highs again, close to 106, which was this prior range support level breakdown. Okay, next one is on Alibaba. Okay, for Alibaba, I think some short-term weakness as price after the lower highs, and then the support over here at 69 couldn't hold, there was a breakdown, and then currently it looks like doing a retest. So I think some near-term resistance should be here around 69 to 70. Then I expect price to come down again towards the next support level at 65. Okay, then for next one is on JD. Okay, for JD, I think for now, nothing too much, still largely in the range, but I think some weakness for a time being, because as we see lower lows are being formed. So potentially we could see a lower high being formed as well below the recent resistance at 107. So I think some continued consolidation or likely a pullback towards prior resistance at around 93 to 94. Okay, next one is on Starhill Global REIT. Okay, Starhill Global REIT, I think it's largely in this range consolidation over here. I think nothing too much will change. Between about 46 to 49 cents area. I think we can expect some continued consolidation going ahead. Next one is on DFI. Okay, for DFI, recently there was a breakdown of this support at around the 194, 195. So I expect either some sideways or either some further downside ahead with the recent breakdown. So currently look like some sideways starting to take place between 178 to 186 about there. So yeah, so it might just go a bit of a sideways for a time being. Okay, then next one is on Hong Kong land. Okay, Hong Kong land recently also broke below this support around 292 and to retest a previous support level at 280, which was a swing low quite long back. This was during May 2020. I also expect some resistance to act around the 290 level upon the retest over here. Then price might just trade sideways for the time being. Okay, next one is on Jardine Matheson. Okay, Jardine Matheson, I think also currently retesting this prior support level. Now try some resistance at 37. Yeah, also recently still seeing a trend of lower highs forming along the way. Also, this 37 to about 37.80 level should be a resistance where price is likely to turn down again to continue its downtrend over here. Okay, next one is on Prime US REIT. Okay, Prime US REIT, I think largely quite range bound over here. The resistance is still around 13.5 cents. So after that, price is turning down again, quite close to this support level at about 10.8 cents level. So I expect some slight rebound to take place over here. With near-term resistance around about 11.6 cents area. Okay, next one is on Manulife REIT. Manulife REIT, I think is still pulling back in this downtrend channel over here. Still, for short-term rise, still bearish. But I think likely to find some support from the retest of this range resistance breakout between 0.062 to 0.064 level. So I expect some support to come in over here, then price to do a bit of bounce with near-term resistance around the 0.067, 0.068 levels. Okay, next one is on ARA Hospitality Trust. Okay, ARA Hospitality Trust, I think for this counter, the volume is rather low, so TA might not be as accurate. Also, yeah, you can see quite a lot of gaps. But overall trend is a downtrend over here. Then short-term wise is quite range bound still. So I expect some range bound between these 27 cents to about 29 cents to actually still continue for the near term. Okay, next one is on Keppel Corp. Keppel Corp, I think after the price some decline last week, it entered into this near the support of 680 over here, some rebound, but also retested this short-term resistance, which is around close to 710 over here with this previous support. So this gap down over here. So I think some slight consolidation is likely for the time being. Okay, next one is on AEM. Okay, for AEM, I think some sideways is quite likely. price is after finding resistance upon a retest of this around 250 level, price has pulled back. Then also currently also retested this prior resistance, now acting as support at 227. So I think price should just kind of sideways between this 227 to about 242 for the time being, this range over here. Okay. Next one is on the 3 local banks as well as STI. Okay, so first one for DBS. Okay, there's a gap down today because of I think there's the split took place today. Yeah, then I think a chart might be inaccurate for now. So, but for now, I think it looks like a retest of this prior resistance around 33. So this was a rather strong resistance back then. Should add some support for now. And near-term resistance wise, you should find it around 35, 30 to about 35.20 about there. Yeah, so yeah, maybe some rebound towards this resistance, then it might come down just some consolidation again. Okay, next one is on OCBC. Okay, I think OCBC likely to be quite range bound. Resistance still around 1390 about there. We have an uptrend channel resistance as well. Which price has sort of turned down previously as well from this level. So I think should be quite range bound in the near term. But we still with higher lows being formed along and uptrend support line. The next one is on UOB. The UOB, I think some strength recently after the consolidation over here, and then there's a break on Thursday. Currently, I think it's the new all-time highs. So I think price could still go higher as long as it can stay above this $30.20 to $30.30 resistance breakout. I think could still trend higher in the near term. Okay, I think I'll answer a few more before I hand over time back to my team. Next one is on Silver Lake. Okay, Silver Lake, some strong rebound recently with volume. Okay, I think, but also retested some this prior support level at 27 cents. This was quite a strong support now acting as resistance level. So I expect price to just kind of sideways over here for a while after a strong run. Near-term support wise is around 25 to about 25.5 cents. So if we just consolidate in this range for a while first. Okay, I'll take one more is on UMS. Okay. Okay, UMS, I think I expect some weakness to actually continue. So with recent looks like bearish spread consolidation, maybe 131 to 138. And then price looks like can't hold this key trendline support, which has acted as a key support previously. So you could still see some further downside if this 126, 127 level can't hold. We could see further decline towards like 120, 122 as the next to retest the lower support levels for UMS. So some short-term weakness possibly for this counter. So that's all from me. I'll hand over time to other colleagues. Thanks.
Yeah, thanks. Yeah, thanks so much, Zane. I think it's already one, so we'll try to stop it. Can someone flash the community page? I know there's still quite a lot of questions. That is there. If possible, try to post it there, and then we try to address it. So I really apologize. We can't take on so many. We try to stop by one. Can someone flash that slide on the community where? So if you join our P3 Poems app, under community, I think you can post some of your TA questions too, and we'll try to address them over there. Yeah, if someone can put that slide.
Yeah, I'm looking for it. We'll flash later.
Yep. Okay. We until then. So thanks everyone for your questions. Yeah, because we did hit one, so we can't take on still some outstanding questions. So we'll try to address them when you post it there. Yeah. Thanks again. Yeah. So we'll wait for that slide to come up. With that, I just wish to thank everyone for your time, spending time with us, and also especially for all your questions. And wish everyone to have a great week ahead. Thank you. Can you explain the slide? Just
Yeah, so here's our P3 community. That is our latest app. Yeah, so in the community, you can post some Q&A and we'll address accordingly. It's under research team. Yeah, I think Singapore research team.
Okay, thanks everyone. So with that, I'd like to thank everyone for your time and hope to see you again next week. Thank you, everybody.